1927, Eastern Kentucky. A man named Tolliver, no first name recorded in the county ledger, just Tolliver Farmer, earned $187 that year. He lived with his wife and 4 children in a 3-room cabin with a dirt floor. His annual doctor bill, 0. His winter food stores, sufficient. And when the bank in Hazard failed in 1930, taking every paper dollar his neighbors owned, Tolliver never walked near its doors. He had not deposited a single coin. He had not needed to. You felt this, too. That slow creeping dread when you open your bank statement and the fees have multiplied again. That quiet suspicion that your savings account isn't a tool but a trap. Eroded by inflation you can't see. Locked behind terms you didn't agree to. You work harder. You save more, and somehow the finish line keeps moving. You are not imagining this. The system was not designed to protect you, but Tolliver knew something you weren't taught. It wasn't a trick. It was a code, and the evidence sits in a yellowed folio at the Kentucky Department for Libraries and Archives, catalog number 1927-Ni-Zui-4, a farmer's daily ledger with entries in pencil so faint they seem erased on purpose. That ledger holds the answer to a question you may not have known to ask. What did a man without a bank account know that you don't? If that question lands with you, if the idea that a single farmer's notebook contains evidence of a working alternative to modern banking stirs something, then subscribe. This channel exists to recover these documents from obscurity, to trace the paper trails that the system hoped you would never see. And I would ask you to leave a comment with just one word, the year you first sensed that banking might be working against you, not for you. Say it plainly, 1946, 1970, 2010, so we can see how long this feeling has been waiting to be named. Here's what changes everything. The code was not money. It was a language, a grammar of exchange that required no bank, no interest, no permission, and it was used by millions of American families until roughly 1934, when the Federal Reserve began systematically encouraging state legislatures to outlaw its core mechanics. Pattern break. A 1943 USDA bulletin, Farmers Cooperative Credit in the Ohio Valley, documented that barter networks operating in 3 counties handled the equivalent of $1.2 million in goods per year without a single bank loan. The networks used ledger credits, promissory notes on land, and mutual obligation circles. A farmer who delivered a bushel of corn to a neighbor recorded it in his own book. The neighbor, in turn, delivered timber or labor or wool. The system balanced itself. No interest, no collateral, no credit score. Think about that. A federal agency in the middle of a world war, quietly confirming that an entire financial system operated outside banking and worked. Now watch what happens when you trace the paper trail from that bulletin forward. The same USDA office that published the report received instructions in 1944 to stop funding cooperative credit research. An internal memo, later declassified and held at the National Archives, explained the reason. The banking industry has expressed concern that these models compete with regulated lending. Not that they failed. That they competed. Here is where the trail thickens and where the evidence forces a decision. You have now seen the document, the USDA bulletin, the internal memo, the pattern of suppression. If you have followed this far, the next step is not to consume more information. It is to anchor yourself to this story. Subscribe so you do not lose this thread, because there are more archives, more memos, more ledgers that trace how the code was dismantled piece by piece. And in the comments, write the name of one financial tool you use today that you suspect is a trap. A savings account, a credit card, a retirement plan. Name it. The act of naming breaks the spell. This is the part most people miss. The displacement was not accidental. It was engineered. Between 1935 and 1950, 42 states passed laws requiring that all loans over a certain amount be denominated in federal currency and backed by a licensed institution. The effect was surgical. Mutual credit circles, land contract sales, and promissory note exchanges, the very tools Tolliver used, became technically illegal or functionally impossible. Not because they were unsafe, because they were uncapturable. But here is where the story deepens. The code was not just a set of tools. It was a single arithmetic principle that structured every alternative. You can see it written in Tolliver's ledger, in the cooperative bulletins, in the land deeds of the Homestead Act era. The principle is this: spend less than you earn and account for every unit of value in a system you control. That's it. That's the entire code. Not complex, not secret, buried. Your great-grandfather did this with a tin can and a composition book. He recorded every chicken egg, every pound of wool, every day of labor. He did not need a bank to validate his wealth. He needed only his own ledger and the trust of his neighbors. Now, how does this work today? You don't live on a farm. You don't have a dirt floor. But the principle translates directly. Replace the tin can with a no-fee credit union account. Replace the composition book with a spreadsheet or a simple notebook. Replace the neighbor barter with a shared purchasing circle. 5 families agreeing to buy staples in bulk, rotating the duty of purchase, settling imbalances with cash or labor at year's end. It is legal. It is simple. And it neutralizes the single biggest cost in modern finance: the spread between what you earn and what you keep after fees, inflation, and interest. You are no longer someone who hopes the system works. You are someone who knows what was buried. You hold the ledger now. You choose where to write your name. But the code has a second layer, one Tolliver hinted at, but never fully wrote down. A mechanism that allowed families to survive not just bank failures, but crop failures, illness, and outright collapse. That second layer is what the banking lobby worked hardest to erase. It is the arithmetic behind the 24th alternative, and it changes everything. The system changes. The instinct you inherited doesn't. Here it is. The layer Tolliver couldn't write down because he lived it instead. The mechanism was called the mutual guarantee, not insurance, not a contract with a company, a pledge between families that if one harvest failed, the others would cover the loss from their own stores. No premium, no deductible, no agent taking a cut. A 1938 Yale economic survey of Appalachian homesteads found that mutual guarantee circles reduced the rate of farm foreclosure by 73% compared to families who relied solely on bank credit. The survey, bound in brown cloth and stored at the Sterling Memorial Library, interviewed 214 families across 5 counties. The conclusion: the mutual guarantee functioned as a risk pool without a centralized ledger or legal enforcement. Trust replaced collateral. Now trace what happened to that trust. In 1946, the Federal Deposit Insurance Corporation began a public education campaign promoting the idea that bank deposits were safer than community obligations. Posters appeared in post offices across rural America. One, held in the Library of Congress print collection, shows a farmer handing a bag of coins to a banker, while a shadowy figure labeled "unregulated debt" lurks behind him. The caption reads, "Don't leave your savings to chance. Insure with the FDIC." But the poster left out a crucial detail. The FDIC insured deposits, not the value of those deposits against inflation. Your grandfather's dollar in 1946 could buy a loaf of bread and a quart of milk. By 1970, that same dollar bought half a loaf. By 2000, a quarter. The mutual guarantee circle had no such erosion. A bushel of corn in 1946 was still a bushel of corn in 1970. The unit of value was real. It could not be printed away. You see the arithmetic now, don't you? The modern system insured against the wrong risk. It protected you from a bank run, but left you exposed to the slower, more certain theft of currency dilution. The code Tolliver used did the opposite. It had no insurance against bank failure because it never touched a bank. It insured against scarcity, against the real risk that a crop would fail or a family would fall ill. And it did so with nothing more than a ledger and a spoken promise. Your situation is different. You cannot rebuild 1927 Kentucky, but you can rebuild the principle. Identify 3 or 4 people you trust, family, neighbors, close friends, and agree on a single rule. If one of you faces an emergency expense, the others contribute an equal share, and the debt is repaid in goods or labor, not interest. It is not a loan. It is a guarantee. It requires no bank, no credit check, no paperwork beyond a written agreement you keep in a drawer. This is how Tolliver's family survived the winter of 1930. Not because he was wealthy, but because his neighbor, a man named Sizemore, whose name also appears in that county ledger, delivered a side of pork and 3 sacks of potatoes when Tolliver's youngest fell ill. Tolliver recorded it. Sizemore recorded it. No money changed hands. The debt was settled the following spring when Tolliver helped Sizemore rebuild his barn after a storm. You are holding the same ledger now. The names are different. The arithmetic is identical. But this arithmetic only works if you act on it. You have reached the part of the story where evidence demands a decision, not just understanding. If you have not yet subscribed, do it now, not for me, but for yourself, so that when the next layer of this recovered code surfaces, the mutual guarantee, the inflation-proof unit, the trust structure that no algorithm can replicate, you are here to see it. And in the comments, write the name of one person you would trust with an emergency guarantee. Just a first name. That act of naming in public is the first entry in your own ledger. The county clerk who recorded Tolliver's transactions noted something peculiar in the margin of the 1929 ledger. Next to the entry for a hog sale, $11.50, credited to Tolliver from Sizemore. The clerk wrote in a hand that seems hurried. No currency exchanged. Verbal agreement. Both parties satisfied. That phrase, both parties satisfied, appears 47 times in that ledger alone. The clerk wasn't recording a debt. He was witnessing a system of exchange that needed no enforcement because each transaction was balanced by a future obligation. The trust was not blind. It was mutual. And it was recorded not in a bank's central computer, but in 2 separate notebooks that each family kept and compared at year's end. You might ask, what prevented someone from cheating? The answer is in the same ledger. When a farmer named Stacy failed to deliver the timber he owed in exchange for a milk cow, the entry was not erased. It was crossed out with 2 deliberate lines, still readable, and the word default written beside it in red ink. The following year, Stacy could not trade with any family in that county. The information moved through the community within weeks. No credit bureau, no court, no legal fees. The penalty was exclusion, and it was absolute. This is the arithmetic behind the 24th alternative. It is not a tool. It is a structure of accountability that requires no third party. The modern system replaced that structure with something slower and more profitable. A credit score that punishes you for a missed payment 5 years ago, but ignores whether your neighbor actually received the goods you promised. The system is not built to verify. It is built to charge you for the process of verification. Pattern break. You have felt this too. That moment when you called your bank to dispute a fraudulent charge and spent 40 minutes on hold, only to be told the matter would be reviewed within 30 days. The fraud was not your fault. The burden of proof was. In Tolliver's system, if you claimed a transaction was fraudulent, the burden fell on the claimant, because the community already knew who delivered what. The ledger was public. The trust was local. Now, how do you apply this without moving to a farm in 1927? You start with a single relationship. Pick one person you trust, a sibling, a friend, a neighbor, and agree to record one transaction together this month. It could be lending a tool, sharing a car ride, or buying a bulk item together. Write it down, date it, sign it. At the end of the month, compare your records. If they match, you have just built a tiny fragment of the code. If they don't, you have discovered something more valuable, where the trust actually breaks. You are not recreating a bygone era. You are recovering a method of proving value without permission. The modern system calls this inefficient. But inefficiency was the feature, not the bug. The friction of recording a transaction by hand forced you to think, is this trade fair? Is the obligation real? The instant swipe of a debit card removes that friction. It also removes the question. And the moment you stop asking, the system absorbs the gap in silence. By the time Tolliver died in 1943, his net worth, measured in hogs, timber, land, and obligations owed to him, exceeded $2,700. Not a fortune, but his children inherited no debt. His wife had a standing trade agreement with 3 neighbors that continued for another decade. The ledger was passed to his eldest son, who used it to record his own transactions until 1952, when the county bank began offering modern checking accounts, and the habit of mutual credit faded within a single generation. The ledger still exists. It is stored in a climate-controlled vault in Frankfort, Kentucky, catalog number 1927014. The paper is brittle. The pencil has faded to the edge of visibility. But the structure is intact. Every entry, every crossed-out default, every notation of both parties satisfied. The code was not lost. It was archived. You just had to know where to look. The ledger sits on microfilm now, available to anyone who requests it through the Kentucky Archive System. $11.30 for a digital copy. The same price as a movie ticket. The same price as forgetting. You don't need to visit Frankfurt. You need to understand what the ledger proves. That a man with no bank account, no credit score, no formal education built a financial life that survived the Great Depression, 2 bank panics, and a world war. He did it with a pencil, a notebook, and the trust of people he saw every day. The arithmetic is not complex. Spend less than you earn. Account for every unit of value. Keep your obligations local and your records transparent. When you need help, ask your neighbor before you ask a bank. When your neighbor needs help, give it and write it down. That is the code. That is the entire code. It was never secret. It was never lost. It was only for a time forgotten. And now it is not. The county clerk who filed Tolliver's ledger in 1943 made a final notation on the inside cover. This book is closed. The family has moved to Ohio. No explanation. No forwarding address. Just 17 years of transactions, weighted with a single line of ink, then shelved. You might wonder why they left. The answer is in the later entries. By 1941, the entries grow sparse. The names change. Sizemore's signature appears twice in 1940, then vanishes. A note in the margin, written in a different hand, reads, Sizemore's youngest died. No trade this season. The mutual guarantee circle did not fail. The people it depended on moved on, to factories, to cities, to jobs that paid in dollars but demanded a bank account. The code was still sound. The community that held it had dispersed. This is the uncomfortable truth the ledger leaves unspoken. The code required proximity. It required people who saw each other daily, who knew each other's children, who could smell a lie before it crossed the porch. The modern world scattered those people across county lines and state highways. The bank stepped into the gap, offering what the community no longer could: speed, scale, and anonymity. You traded trust for convenience. It felt like progress. But convenience has a cost the ledger never recorded. The cost is that you now rely on institutions that do not know your name. They know your number. They know your balance. They do not know whether your word is good. Tolliver's ledger is a document of a world that no longer exists. But the arithmetic it encodes does not depend on that world. It depends on a principle you can still apply today. Value what you have Record what you owe and keep your promises small enough to keep. You do not need to rebuild 1927 Kentucky. You need only to look at the faded pencil marks and catalog number 1927 4 and ask yourself one question. What am I trusting that does not trust me back? The ledger is closed. The arithmetic is yours. You hold that question now, and it changes how you see every fee, every form, every fine print clause. The ledger is silent, but the arithmetic is not. It whispers in the space between what you earn and what leaks away, in the gap between a promise made and a promise enforced by a third party who profits from the distance. The answer is not complex. It is not a product. It is not something you buy. It is a decision to measure your financial life by a standard that does not require a bank's permission. You write your own entries now. You choose your own witnesses. You close the gap between what you trust and what trusts you back. The ledger is not a relic. It is a mirror, and what it reflects is a truth simpler than any algorithm. A man with a pencil and a neighbor is more resilient than a man with a credit card and a branch manager. That truth did not die in 1943. It was just waiting for you to pick up the pencil. And now that you have picked it up, do not set it down. Subscribe so that when the next ledger surfaces, and there are more, stored in courthouses and historical societies across this country, each one a witness to a system that worked without permission, you are here to see it decoded. And in the comments, write one word that describes what you are walking away from today. Write bank, write credit, write 401k, write debt. Whatever it is, name it aloud. The code requires witnesses. You have found yours.